Hi everyone, this is David Gellner and Parker Ksidakis with the Gellner team of Kidder Mathews. We specialize in commercial investment sales in the Pacific Northwest and wanted to sit here today, mid-year market update, give everyone the update on what we're seeing since the start of this year and what we expect for the rest of 2026.
Yeah, to start, I think state of the market as a whole, we're seeing a lot of inventory pooling. So just in the snapshot of April, we saw 52 single tenant deals hit the market, only 33 sold in that same month. And then similar for multi-tenant, there's 29 multi-tenant deals that hit the market and 21 multi-tenant shopping centers that sold. So as a whole, there's about 25% of inventory as we're viewing it that's kind of starting to pool and just accumulate on the market.
Yeah, the broader framework since the start of this year is we've seen more listings or sellers than there are actual buyers or transactions taking place in the marketplace. The fundamentals of why I think we're seeing that in our specific market versus others on a more national basis is simply just what's taken place locally with the political and tax environment. So about a year or so ago, we had the large estate tax increase, which we've talked about and I think everyone's aware of now. And then to start this year, we had the passage of the upcoming and future income tax. And so what that has done for a lot of our clientele that have owned for a long time historically, or some of these legacy ownership groups, is now they've realized that there is some future implications and they're looking to migrate their portfolio, some of their assets, to other states that are more advantageous for them on that perspective. So I think we're going to continue to see more and more inventory the later half of the year, and there's just more opportunities for buyers, especially those in exchanges. Not, I guess big picture again, the last 2 years we really haven't seen a lot of inventory hit the market, and it's really kind of kept things stabilized as far as pricing and cap rates. But now with the inventory continuing to grow, it's just becoming more of a competitive marketplace.
Where are you seeing the deepest buyer pool right now, or of the buyers out there, what markets are they targeting?
That's another great thing to talk about is, to start this year, we have really seen a lot more depth in the suburban markets, specifically Clark County seems to be a very active buyer pool. We have 2 shopping centers under contract right now in Clark County. One closes the end of this month, the other's going to close in 30 to 45 days, but we've received multiple offers on both of those shopping centers that are, one's 1980s construction, the other's 2000 construction, but really big buyer pool. And that goes back to the migration of capital. Both of those groups are based out of Portland, the top performing buyers on those. But and we've seen a lot of buyer activity come from the Portland core looking to get into Clark County. I would say outside of the Seattle core, we're seeing more and more buyer pool continue to target the suburbs. I-5 corridor outside of Seattle remains pretty deep from what I feel. What are you seeing?
Yeah, I agree. I think it's I-5 corridor is always what we're looking at. I know folks kind of look in the I-5 corridor and then start looking east, but I also think we've seen a lot more California buyers, which is atypical of the Northwest. We track all this data, and typically 80% of multi-tenant buyers come out of Washington into Washington, and we've had multiple offers from California now actually on our larger shopping centers up here.
Yeah, and I think that's driven mainly by the spread between, especially on the triple net or new construction product in California versus Washington, where we're probably 50 basis points higher on a cap rate basis, that at least than down in California. So it's still a very attractive yield-driven market up here when you're comparing the two. I would say the other things that we've seen continue to spread or change with time is just the year built of construction and the cap rate spread between, let's call it 2000 and newer product versus earlier than 2000. We're seeing, that premium buyer pool that's not necessarily chasing yield or the highest cap rate. They're chasing quality and a newer age of construction. We're continuing to see that spread out. A case study example would be we just sold a couple months ago a new shopping center in Bonnie Lake, Washington, $9.5 million sales price, and that sold at a 5.7% cap rate. 3 offers generated within 30 days of marketing, and ultimately it was a 1031 exchange buyer that we procured out of California that came up here and fell in love with not just the market, but the quality of construction and new product.
Yeah, I think to your point with the yield sensitive versus not as yield sensitive buyers, that seems to be a spread too, with not as many in the middle, where the yield buyers want yield, and they, with interest rates where they're at, they're going to put debt on it, and the yields have to make sense to them. So that's where it's pushed, a lot of those kind of older buildings up in cap rate, where if somebody just wants super quality, super stable, they might be less yield sensitive, and that's where we've seen the kind of split in the sub 6 caps versus the 8+ cap deals.
Yeah, and I think the older product specifically, if you're getting a buyer or an investor that's coming in looking at older product there and they've owned in the marketplace or just owned similar product in the past, I think with what's happened with rising costs over the last 3 to 5 years, everyone's fully aware that to replace a roof, HVAC, siding, parking lots, those costs have gone up substantially if we look at what they were 5 years ago. And so that's one of our recommendations to clients, pre-listing is, hey, let's, double check and get some contractors on site to tidy things up and know exactly where the property components stand, because during our due diligence, that is something on the older product that continually comes up is just deferred maintenance. And usually it's really roof and HVAC, and knowing exactly the life expectancy on those so that we can overcome those during the transaction if those arise.
Definitely. Where do you see the opportunity today? Or, if you were in a 1031, what would you be looking at?
Man, I am more bullish on the retail commercial aspect, especially in our marketplace than I probably ever have been. In 15 years that we've been solely focused on doing retail and commercial investment sales, I think if you lens out and look at the different assets, whether it's, let's just focus on the apartment side, if I'm an investor with a few $1 million looking to buy an investment property right now, I think retail is, in my opinion, I know I'm biased, but over and beyond the best asset class to be in right now for our market. You can't very difficult to build shopping centers, especially the typical strip malls. Those costs of construction are well above what you're able to buy older vintage product at right now. But going and looking at, hey, even with the price reductions we've seen in multifamily rents have been stagnant for 3 years at least, while operating costs have increased dramatically. And there's no insulation because there's no triple net lease in multifamily versus retail. Maybe you've seen some stagnation in rent growth. We really haven't seen that much because of the cost of construction for these tenants. But then you have that triple net lease, so that when you have, like case in point, a fire levy come out of the city of Lakewood that increases property taxes, $30,000 a year, the tenants you're insulated as the ownership in the triple net lease component. And so, yes, that's going to affect future rental growth, but at least you're not just taking that to the bottom line NOI like you are in every other asset class outside of retail and commercial with the triple net leases. So I think with the rise in inventory, there's more product at a really attractive basis in year one cap rate, that I've ever seen. And so I think now's a great time to get a great going in cap rate and yield with future rental growth and in a very attractive basis that you could never construct these properties ever again at in our marketplace. What do you think? Where do you see the opportunity?
I agree. I was just on a call yesterday, and talking with one of our leasing brokers, and kind of the story we've heard now for a while, because we've been talking about, vacancy rates are sub 3%, but a lot of these tenants are just knowing and choosing to stay in place with their current rent because it's so hard to move, even on a junior box or a 10 to 20,000 square foot box. So I also think, I know we were talking about Rite Aid at this time a year ago, but I do really like retail, and I like, knowing, or at least knowing which tenants are really strong out there and like where they're at, and knowing how hard it is to move, do the TI package again, just everything's so expensive, and they'd rather optimize where they're at versus trying to get a marginally better location elsewhere.
I agree. And vacancy for shop space in all of Washington really remains right around 3%. Haven't seen a major change in that in the last year. And so I think it's a great opportunity. And we are seeing a lot of crossover from typical, whether it's office owners, apartment owners who are now kind of burnt out of that segment migrating into retail. And so I think it continues to be retail's time to shine, and we're really excited and bullish for the next 6 months to end the year. If you have any questions on this video or we can be of any service, please reach out to Parker and I or the team anytime, and thanks for listening.